these markets, you heard Jim. Jim didn't sound real optimistic in the near term, so kind of let it out. I mean, sounds like more downside ahead. What do you think?
I think so, Brian. I would use this opportunity really to leg into much more high quality companies. And I think, and the way we're defining that are companies that generate free cash flow. I think any company that's very dependent upon the capital markets for growth, in my opinion, is going to continue to have problems. One of the first things we all learn in this business from old Marty Zweig is don't fight the Fed. The Fed has only just begun. The Fed's only tightened twice. It hasn't actually started balance sheet runoff. That starts tomorrow. And my own opinion is that people are a little bit, perhaps a little bit premature in thinking that the Fed is going to wave the checkered flag by the fall. I just don't believe that. I think we're in for a period of tightening for a while.
Yeah, Jason, I mean, Waller, the Fed's Waller last night, and he was in Germany. That's why he was speaking on a market close day, effectively said, no. At least in his view, they're going to keep raising 0.5% at every meeting. I mean, I guess the only question is, you talked about the Fed sort of waving the checkered flag. Do we know how much the markets, stock and bond markets, have already priced in? It's not like we don't know the Fed's going to keep raising. So how much of that rate hike damage has already been done? I think that's the only question we need to answer.
I'm somewhat skeptical that much of it has been priced in, and that's partly, I would say, partly anecdotal. I travel around the country, as my colleagues do, and we visit with institutional investors, and I think a lot of people are very, almost addicted to growth stocks, or certainly, deep growth stocks, you could put it that way, that again have done so well. And I understand the impulse, and it's hard to give those up, but I think the tide's going out now, and this is a bit different. And there's a lot of us in the business. If you have been in the business, as I have, you've seen this before, but it's been a long time. And then there's an awful lot of people, obviously, in the business that are managing serious money that haven't seen it at all, right? So it's been 14 years since the Fed started quantitative easing. And so this is the transition from quantitative easing to quantitative tightening, in my opinion, is one of the most significant changes in monetary policy that we've seen in probably 14 years.
So how do you change your playbook as a result?
Becky, I'm not sure you change it that much. You probably hold a little bit more cash. You hold. We've been very optimistic on energy, on basic materials. This morning, we're increasing our exposure to utilities. So you want to be more defensive. And again, I think the balance sheet and the company's ability to generate cash, maybe more than the sectors, is going to be much more important. And I also would say, in terms of bonds, I would be careful. I think there's a lot of people that think that 3 to 3.5% may be the upper limit on bond yields. It's possible, but yeah. I don't think you've had a free market in bonds for 14 years.
That's
so
it?
We're going to find out what the real price is soon, it seems to be.